Hey, welcome back to the show. Today we're diving into the financial results of ITI Limited for the quarter and 9 months ended December 31st, 2024. Buckle up, it's a bit of a bumpy ride, but we'll try to make it fun.
Absolutely. ITI Limited, an Indian government undertaking primarily in the telecom equipment business, just released their unaudited, standalone, and consolidated financial results. And well, there's a lot to unpack. Think of it like opening a mystery box. You're never quite sure what you're going to get, right?
Exactly. So let's start with a quick overview. What exactly does ITI Limited do and where do they operate?
ITI Limited, or Indian Telephone Industries Limited, mainly manufactures, trades, and services telecommunication equipment. They operate primarily in India and are also involved in defense projects. They've been around since 1950, and although they are primarily based in India, they are a global company.
Got it. Now, I see some notes mentioning strategic developments. Anything big happening there?
Well, ITI was declared a sick company and is currently under a revival plan approved by the Cabinet Committee on Economic Affairs. This plan includes financial assistance, and they've received a significant chunk of it so far, about 3,025.35 crores out of 4,156.79 crores sanctioned. It's like a patient getting ongoing treatment to recover.
Okay, that's a pretty significant amount. Let's jump into the income statement then. How did they perform in terms of revenue, EBITDA, and all those key metrics? Remember to cover both standalone and consolidated results.
All right, let's break it down. For the consolidated results, the revenue from operations for the quarter ended December 31st, 2024 was 1,034.54 crores, compared to just 258.84 crores for the same quarter last year. That sounds great, right? But hold on. The total expenses were significantly higher at 1,121.82 crores, leading to a loss before tax of 48.88 crores.
Ouch. So higher revenue, but still a loss. How about the standalone figures? Are they any different?
Surprisingly, the standalone numbers mirror the consolidated ones almost exactly, with a revenue from operations of 1,034.54 crores and a similar loss before tax of 67.12 crores. This suggests that the parent company's performance heavily influences the consolidated results, and there isn't much difference between the two.
Interesting. Any one-time events or exceptional items that we should be aware of?
There was an exceptional item of negative 27.38 crores.
So no dividends declared, I assume, given the losses?
Correct. There's no mention of any dividend declarations in this report.
Right. Let's switch gears to the balance sheet. What are the key highlights in terms of assets, liabilities, and equity?
Well, let's just say the balance sheet reflects the challenges the company is facing. Without specific figures in front of me, I can tell you that it would be important to scrutinize their debt levels and asset quality for both standalone and consolidated entities. Rising debt or declining asset quality could raise some serious solvency and liquidity concerns.
Good point. And what about cash flow? Is there enough to sustain operations, or are they burning through cash?
Given the losses we discussed earlier, I'd be very interested to see if their operating cash flow is positive or negative. They mention a large order book, so converting that into actual cash is crucial. Without positive cash flow, sustaining operations and fulfilling those orders could become difficult.
What about the key financial ratios? How do they stack up?
Again, without the actual balance sheet numbers, it's tough to give precise ratios, but I'd be looking at things like their debt to equity ratio, current ratio, and quick ratio. These will give us a sense of their leverage and short-term liquidity. I'd also compare their profitability ratios like gross margin and net margin to previous periods and industry benchmarks.
Makes sense. Now, the auditors have issued a review report. What are the key concerns they've raised?
The auditor's review report is where things get really interesting. They've issued a disclaimer of conclusion for both the standalone and consolidated results. This is a pretty serious deal. It means they couldn't obtain enough appropriate evidence to form an opinion on the financial statements. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Wow, a disclaimer of conclusion? That sounds bad. What are the reasons behind it?
There are several reasons. One major issue issue is that the company is recognizing revenue on the dispatch of goods even when installation and commissioning are still in progress. The auditors couldn't verify if this revenue recognition complies with accounting standards, specifically Ind AS 115.
That sounds like a significant issue with revenue recognition. What else?
They also mention issues with obtaining bank confirmations, actuarial valuations for employee benefits, and irregularities related to a memorandum of understanding with the government of West Bengal. It seems like there's a lack of sufficient documentation and transparency in several areas.
Okay, so a lot of red flags there. What about the branch auditors? Did they raise any concerns?
Yes, the branch auditors for Palakkad, Naini, and Raebareli units also reported several issues. These include overdue accounts receivable, potentially obsolete inventory, inadequate processes for identifying and paying MSMEs, and unbilled revenue.
Unbilled revenue, that's a recurring theme, isn't it?
It is. The Raebareli unit, for example, has a significant amount of unbilled revenue from previous years. This, combined with issues like the expired lease agreement with NIFT and unpaid TDS on salaries, paints a concerning picture.
So, with all these issues, what's the auditor's view on the company's ability to continue as a going concern?
The auditors have highlighted a material uncertainty on going concern. While the management believes they can continue operating based on the large order book and government support, the significant losses and other issues raise substantial doubts. It's like saying, we hope for the best, but there are serious risks, right?
Right. So, summing it all up, what's your overall assessment of ITI Limited's financial health and future prospects based on this report?
Well, based on the information we have, ITI Limited appears to be facing significant financial challenges. The disclaimer of conclusion from the auditors, combined with the numerous issues raised in their report and the branch auditors' reports, suggests a high level of risk. It's like navigating a minefield. You need to proceed with extreme caution.
So, would you say it's a favorable, neutral, or risky investment right now?
Given all the uncertainties and red flags, I would definitely classify it as a risky investment at this point. While the company has a large order book and government support, the financial statements raise too many concerns to ignore. Like it could go either way, but the odds don't seem to be in their favor right now.
Thanks for breaking that down. It sounds like a lot needs to improve before the company stabilizes and becomes a reliable investment. And to our listeners, remember to like, share, and subscribe for more financial deep dives. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Absolutely.